Hey everybody, my name is Rick, off the tape. I just wanted to make a really quick video to say thank you. I got a lot of new subs this week, and I want to thank Brent for trusting my work to highlight me in his morning notes, so thank you for that. A lot of you have reached out to me with really smart questions, and one of the recurring questions that I get was, how do I define offsides? And I never did a primer on Substack because I didn't think anybody was going to be reading this but me. So that's what I'm going to attempt to do right here. I'm going to put the text of this also at the bottom of today's post, which is Friday. If you don't want to hear my voice, just skip over this, read. But if you're like me, after a long week, your eyes are shot. I'd rather just listen to somebody speak. So very quickly, let's just talk about Edge. I've been trading my own account for almost 15 years, and my bread and butter is event-driven news and merger arbitrage. And my edge is speed. I find things before other people. I trade them. When everybody else sees these things, I get out. I'm also very up to speed on all the event-driven and merger arbitrage situations, so I'm able to react when news does come out, and if something is mispriced according to my experience or the models that I've built, I'll trade and then I'll get out. So about 18 months ago, I decided, maybe just out of curiosity, to come up with a more systematic, scalable, durable process that I could run, I don't know, in my PA retirement account, maybe trading someone's capital somewhere one day. I don't know. I don't really have too much of a plan for this at this point, but I'm just trying to optimize the system and optimize my process. So I took a step back and I asked myself, I know what my edge is, trading short-term news and event-driven. How do I do that if I want to create an intermediate-term system? Intermediate, in my definition, is 2, 3, 4 weeks plus. And I've been doing this for a really long time. Obviously, I know that you need some sort of an edge, but information is so fast these days and so ubiquitous and free that how could you possibly find an edge trading something out 1 or 2 or 3 weeks, right? And I thought a lot about all my experience, and to me, the most obvious things, the most recurring thing that I've seen in my entire career, not just with myself, but with other people, is you have to understand positioning and you have to understand the setup, whether it's into an event, a catalyst, or on the back of news. How many times have we seen very bearish US dollar news? I'm just making this up as an example. The US dollar trades higher on the day. Why? Everybody's just short, right? Everybody's offsides. So I'll walk you through really quickly from a high level how I think about these, how I calculate this and how I think about it. I'm going to simplify it. I'm not going to bore you with the stats and my regression analysis and all this other stuff that I'm doing in the background, but I look at the Commitment of Traders report, which comes out on Friday afternoon. The data is as of the previous Tuesday, so the data is 3 days stale. I kind of like that the data is stale, because if this was instantaneous data that could be black boxed, I would have no edge. You'd have no edge. The guys that front run and co-locate would be able to beat us, right? So the data is 3 days stale. And again, oversimplifying, there are 3 buckets, right? You have institutional speculators, you have retail speculators. They're over under some hurdle, I don't know what it is. And then you have the commercials, which are corporations. Let's just look at think about a wheat producer or an energy producer. They're just hedging their production. They want to smooth out their cash flow, smooth out their returns. It lowers their cost of capital or improves their valuation, all that good stuff. So what I do is I take the institutional and the retail and I combine them and I create a histogram. There's some debate about making sure that the institutional and the retailer are both offsides in one direction. But I've back tested this greatly. And surprisingly, the retail speculator in all the work that I've done shows me that they're actually not worse off traders. If they were, I would look at nothing else, right? I would create a histogram of those guys. I would figure out if they were offsides. I'd apply the technical analysis and the discretion that I do, and that's all that I would trade. But since the returns they're not statistically significant, I just combine them. If you do it your way and it's different and it works for you, that's great. I respect it. So one other point to that too is in a lot of these markets, the retail speculator is very small. They're irrelevant. But I urge you to look at an instrument like silver, highly, highly liquid, of course. Retail is a significant portion of that. I think, don't quote me, it's maybe a quarter of the average positioning at the end of each week for the last 1 or 2 months is like 25 or 30%. It's a real number. So I combine them. Then what I do, I guess, if you want to call it the proprietary nature of what I'm doing, is I create an oscillator that has a certain look-back period. And that oscillator is kind of akin to like a mean reversion of positioning. It's almost like it's forecasting what the turn could be either way. And again, I pair that with various technical indicators. So the gist of it is that's what I'm doing. I'm looking at this oscillator that I've created. Now, somebody asked me a really great question. 2 people actually asked me the same question. They pointed out that I highlighted the Mexican peso in my chart deck from Tuesday. And I highlighted that it was offsides short. And the questions were, how could you say it's offside short if the net speculator positioning is long? That's a correct observation. The net speculator positioning is long. But because of this oscillator that I'm looking at, offside short could also mean least long and vice versa. So again, I'm just looking for, we got over our skis the last couple weeks or even the last couple of months, and you're looking for some sort of mean reversion. You can't just fade offsides positioning short or long because you need, some people call it market confirmation, or you need some sort of technical thing or discretion or whatever you want, whatever you do in your process. I'm just here to just show you the positioning that I'm looking at and show you what I'm doing for this oscillator that I've created. Now, just a side note, the absolute best setups, I think, through experience trading, my stats, my back test, is when the oscillator shows me that positioning is offsides short on the oscillator, but also absolute net short over maybe the last 12 months or the last 18 months. The charts that I put in each week, I think, go back to about 18 months. I have more data than that, but the chart just becomes less relevant. And, with market changes and regime changes, things, I think that's probably too stale, at least for what I do. If it works for you, then great. So let's think about the Japanese yen, for example, before the unwind. Positioning on the oscillator was offside short. You also had an offsides absolute short. Then the unwind came, right? Obviously, big unwind, big explosion, and it was pretty obvious to me that it was going to take at least a couple of weeks. I mean, it went from offsides short to offsides long very quickly. But you kind of it just had that feel of, all right, this is a really big unwind. We really don't know how big this thing is. This thing could last a little bit more. And then as soon as the chart goes off the leash, what happens? All the CTAs, their signals light up, then they start buying it, then they get full, then they get over their skis. And the same exact thing happened. On the oscillator, speculators got offsides long. It was also at absolute net long. And then what happened? We had the rollover in the yen, right? This doesn't always work. Again, this is just a data point for you to use in your process. So that's really it. Somebody asked me, Somebody asked me why I'm doing this, and I don't really know why I'm doing this. I just thought maybe it would be fun. I like when people reach out to me. I like the camaraderie. I like when we can share ideas. We've got the Discord thing going as well. I've got some really smart people in there, and it's a quiet Discord. It's not noisy at all. A really good friend of mine, he's a trader. He's been doing this for a long time also. He's got a podcast called Trading Life, and I recommend it. I'll link it in the thing. But the reason I bring it up is because we talk about ideas, we talk about trades a lot, we commiserate a lot. And he said something really smart to me, these two words. He always says, stay curious. And it's so important, whether it's in life or in trading, especially in trading. You've got to stay curious about what you're doing. You've got to stay curious about your process. You have to always think about optimizing your process. So I thought that was something worth mentioning, because that was really probably the genesis of me doing this project. I mean, I'm making a good living. I'm doing my thing, and again, I just felt like maybe it was just the curiosity that made me want to change things up a little bit. So that's it. If I do another video, I'll make it much shorter. I'll try to make it more professional. Obviously, this is just a cell phone thing. I have no idea what I'm doing on YouTube. But I'll see you in the next one.